Good afternoon, everyone, from a sunny but fresh Overberg. Welcome to our third installment of the quarterly webinar. We've got Nick Downing presenting today. He's the founder, CEO, and Chief Investment Officer at Overberg Asset Management. Nick will cover a range of topics today. So first up, we'll be looking back at the last quarter, looking at the markets, economic data points, then looking forward, the outlook for the markets and the global economy. And then next up, Nick will draw parallels between the current state of the US economy and the economic environment in the 1990s. We'll look at projected asset class returns for the rest of this year and for 2025. And then looking inwards to our own portfolios, Nick will discuss our global portfolios. And then also how have we positioned the portfolios for the rest of the year. Next up, we're going to look at investment company valuations and the recognition by big funds in this sphere. And then finally, we're going to end the session with a Q&A, and we're going to be answering a few questions from clients sent in via their wealth managers. And I do encourage the listeners to send in questions to us at info@overberg.biz, and we'll cover it in the next webinar, or if it's something very topical, then we'll reach out and make sure to answer those questions. So without any further ado, I'll hand you over to Nick Downing.
Thank you very much, Carl. Welcome everyone to this third webinar. So we'll begin with the economic and market review. The US growth has been supported by rising household wealth, strong household and company balance sheets, and a well-capitalized banking system. Strong balance sheets make businesses and consumers less susceptible to higher interest rates. Indeed, there are no structural imbalances in the US economy. The economy is in rude health. The Federal Reserve, in its March policy meeting, raised its GDP forecast for 2024 from 1.4% to 2.1%. The Congressional Budget Office raised its estimate of 10-year potential real GDP growth from 1.8% to 2.1% to account for higher immigration flows. A clear trend has emerged of a broadening recovery in the world economy, led by the manufacturing sector. The synchronized global economic recovery has lifted earnings in the US as well as globally. The consequence of robust growth, however, is that inflation has declined by less than had been hoped for by some central banks, in particular by the Federal Reserve. Some analysts believe inflation will remain higher than desired due to the US and Europe no longer suffering the deleveraging drags on growth that existed in the post-global financial crisis decade. Others, however, including the Fed, believe inflation will return to target levels, albeit at a slower pace. While the US has suffered 3 consecutive months of inflation data disappointments, CPI inflation in Canada, Europe, and the UK has dropped faster than expected. The Fed has stuck to its forecast of 3 25 basis points interest rate cuts in 2024, but has not given a firm indication of when this will begin. Meanwhile, the Swiss National Bank initiated its rate cutting cycle in March. The first central bank intended to do so with a 25 basis point rate cut from 1.75% 0%. Also in the quarter, the Bank of England, the outlier, lifted its rate for the first time in 17 years from minus 0.1% to plus 0.1%, ending its era of negative interest rates. So, inflation disappointments coupled with robust growth cause bond yields to rise. When bond yields rise, prices drop. And this rise was led by the 10-year US Treasury bond yield. The S&P G7 Sovereign Bond Index lost 2.3% in the first quarter. The paring back in interest rate cut forecasts, however, did not prevent the world's equities from rising quite sharply in the quarter. Share price gains were backed by solid earnings growth. The Nikkei outperformed with a 20.6% return in Q1, as well as officially beating deflation. The shift in structural reforms, corporate restructuring, and improved corporate governance is gaining momentum for the benefit of profit margins and shareholder returns. The US economy has been resilient. We can see the economy re-accelerating despite the fact that interest rates have had their steepest increase in over 40 years. The US economy has been resilient and continued to surprise on the upside. Consensus forecasts have shifted from hard landing and then to soft landing and now no landing. Growth has been accelerating in recent quarters. Consumers benefit from a strong labour market, clean balance sheets, and solid income growth. Companies enjoy low indebtedness, strong profits, and high cash flows. The global manufacturing sector has shown a broad-based recovery since mid-2023. You can see this sharp decline in 2022, 2023, mid-2023, it's starting to pick up, and indeed currently accelerating. China's exports have increased 20% in recent months. The manufacturing cycle tends to lead the global economy. The global economy is experiencing a synchronized upswing. Leading indicators of all major economies are accelerating. The US manufacturing ISM Purchasing Managers Index has turned positive for the first time in 16 months. Here we go, moving just above the neutral 50 level. China's PMI shows a sharp spike in new orders, this blue line. The Eurozone ZEW expectation survey has improved markedly. That's the red dotted line right there. Economic and market outlook. Although not the largest sector, the manufacturing sector typically leads the world economic cycle. The trend is confirmed by forward-looking surveys such as Purchasing Managers Indices and a noticeable upturn in global trade and shipping volumes. US company earnings strengthened for a second consecutive quarter, confirming an improvement in the overall profit cycle. Aggregate earnings of the S&P 500 index grew in Q4 by 10% year on year, up from 7.5% in Q3. Consensus earnings forecasts anticipate 9% earnings growth in 2024 and 18% in Europe, even higher due to there being a much lower base. Worldwide, earnings were in a solid uptrend. The jury is still out on inflation's trajectory. In the US, where inflation is proving most problematic, the Fed believes recent data disappointments are simply bumps along a descending path to the 2% target. The Fed has raised its preferred core PCE inflation forecast for 2024 from 2.4% to 2.6%, but kept its 2025 and 2026 forecasts unchanged at 2.2% and 2.0%. The two key culprits are shelter inflation and services inflation. Upcoming graphs will illustrate how both are predicted to come down. The Fed has acknowledged that strong growth and sticky inflation will delay the start of its rate cutting cycle. From predicting 25 basis point rate cuts in 2024 at the start of the year, the Fed funds futures market is now only predicting 2. However, the Bank of Canada, the ECB, and the Bank of England are all expected to initiate their interest rate cutting cycles possibly as early as June. In Canada, CPI is already in line with its central bank 2% target. Solid equity market returns are expected in 2024 and 2025, despite a slight deferral in the US interest rate easing cycle. Equity market prices are guided by two key forces: the price-earnings multiple, the PE multiple, and earnings. The PE multiple is largely determined by investor sentiment, but also by prevailing interest rates. Earlier predictions of further PE multiple expansion may be trimmed back. However, earnings growth, where the outlook is getting brighter, is a more important driver of longer-term equity market gains. Global ex-US equity markets trade at a sizable discount to US markets, and some are enjoying faster earnings growth than the US, for instance, Europe. A synchronized recovery in the world economy suggests a possible shift in leadership from US to non-US markets. However, we believe US markets will continue to outperform on a 2-year view, led by a new and large-scale artificial intelligence industry, with a strong possibility that a bubble may develop over the coming 2 years. Global 12-month forward earnings are in a solid uptrend. As you can see here, a little bit of a dip, 2022, 2023, and now a solid trend. US earnings have led the way, but as the global economic recovery broadens, other regions are beginning to catch up. After the pronounced slowdown in 2022, 2023, global earnings growth is building momentum. So this is the annual percentage change in global 12-month forward earnings. We can see a strong increase in positive momentum. The earnings outlook will support equity markets. The general outlook for US earnings growth is positive, but technology is leading the way. Profit margins are at an all-time high, and 12-month projected earnings growth is the strongest since the 2008 2009 global financial crisis. The paths of the Magnificent Seven have started to diverge. Since the start of the year, Nvidia's share price has gained over 50%, but Tesla has lost around 40%. So the moniker has changed to the Fantastic Four, comprising Nvidia, Meta, Amazon, and Microsoft. The main sticking point for US inflation is shelter inflation. Excluding shelter, core CPI, consumer prices and inflation, is already close to the Fed's 2% target. We can see how rapidly it went up in 2020, 2021, coming all the way down just as rapidly, and excluding shelter, already back to 2%. Changes in market rents are only gradually incorporated into CPI. Shelter CPI lags the new tenant rental index by around a year. Given the sharp slowdown in new rents, this is the dotted line, new rents are minus 4.0% year on year, deeply negative. So given the sharp slowdown in new rents, the shelter component of CPI, which is currently stuck around 7.5%, falls from its current level. Services inflation excluding shelter, known as super core inflation, has begun to re-accelerate, this blue line. This is anomalous as it is closely correlated with wages. The US wages measured by the Atlanta Fed wage growth tracker, and that you can see is in a clear downtrend, the red spotted line. Wages are expected to continue declining based on the slowdown in hiring. The lags could be longer in this economic cycle, but core services inflation is unlikely to persist if wage growth continues to ease. 3 straight inflation data misses in the US and the re-acceleration of core services ex-shelter inflation, which is closely followed by the Fed, have tempered the market's interest rate cut expectations. From predicting 6 25 basis point rate cuts in 2024 at the start of this year, Fed funds futures are now only predicting 2. So this was the Fed funds forward curve on December the 13th, expectations being trimmed back to March the 1st after a couple of poor inflation figures and then another inflation figure moving the expectation even further up the y-axis. Interest rates will come down eventually. The Swiss National Bank has led the process. We can see one rate cut already, with a cut from 1.75% to 1.5% in March. The ECB and the BOE will likely come next, possibly as early as June. So the ECB is the red one, the BOE the one above it, and the Federal Reserve the one above that. And the dotted lines are the expected rate cuts over the next couple of years. The Fed will most likely begin cutting its rate in September. It doesn't want to be too close to the November election date in case it gets called in for political favor. So we're probably expecting a Fed rate cut in September. The slight tempering in interest rate expectations may slow the re-rating process. There's been a powerful re-rating in the expectation of sharp interest rate cuts across all the major markets. And that re-rating, the increase in the PE multiple may slow. However, steady earnings growth, the AI investment boom, and its productivity benefits should continue to support share prices. The US, this one at the top, merits its premium over other developed markets, being the main beneficiary of development and expenditure in artificial intelligence. Emerging markets will benefit from the global industrial upswing, although valuations have diverged sharply between markets. Valuations in India, up here, have become quite stretched, but are extremely low in China, reflecting the contrasting outlooks for the two economies. The current US economic and equity market context is very similar to the so-called Goldilocks period in the second half of the 1990s. Then, as now, we had a peak in interest rates at the same time as a positive turn in economic activity. There was also a technology investment boom and falling inflation linked not to artificial intelligence then, but to the internet revolution. The Fed hiked the Fed funds rate from 3% to 6% over just 12 months, followed by 75 basis points of rate cuts between July 95 and January 96. The interest rate cuts added fuel to the solids earning growth, prompting a 40% rise in the S&P 500 index in just 1 year, initiating the great bull market that ran from 95 to 2000, culminating in the dot-com bubble. The US economy expanded at a 4.2% annualized pace between Q1, the first quarter 95, and the first quarter 2000, when the S&P 500 peaked. Real tech spending on information equipment and software increased by more than 20% annually over the 5 years, similar to the current rate of technology expenditure. Despite the surge in economic growth, inflation was kept at a moderate 2.4% annual average over the period, helped by a surge in labour productivity. Productivity growth, after languishing around 1% for a prolonged period, accelerated in line with the internet revolution from 1% to 3.5%, at the same time boosting GDP and capping inflation. Over 5 years, the S&P 500 gained by an annual compound rate of 25%. The near doubling in the PE multiple from 12.4 to 25.5 over the period contributed around 15 percentage points to the S&P 500 annual compound returns. The S&P 500 currently trades on a 20 times PE multiple, but there is potential for some upward rating to complement the solid expected earnings growth. The prospect today of Fed rate cuts after a steep tightening cycle, so this is in 95-96, resembles a period in early 95 when the Fed finished its hiking cycle and implemented 3 25 basis rate cuts over 7 months. The rate cuts triggered a 40% rise in the S&P 500 over the period. The bull market continued thanks to the internet revolution, and despite a rate hike in early 97 and substantial monetary tightening in 1999. The asset class returns, equities are expected to outperform bonds over the next 2 years, supported by resilient economic growth and monetary easing cycles. The economic recovery is broadening globally, but the US market should continue to outperform amid an AI-fueled bubble. So the OAM global portfolios. We have a long track record going back to 2003, over 20 years. We manage the global portfolios using investment companies listed on the London Stock Exchange. We are very conservative. The portfolios have broad global diversification across asset classes, currencies, and geographical regions. So you can see the regional breakdown: the US, Europe, UK, emerging markets, other, and Japan. You can see equities, 50%. This is a global balanced portfolio. Private equity, bonds and credit. All these alternative asset classes can be accessed uniquely through investment companies. Infrastructure, absolute return, cash and real estate. Year to date, up 3.58%. Of course, translated into Rand, the performance is far better. This performance in pound sterling, since inception, compound annual return of 7.11%, beating the benchmark 6.79%. And this is the graph, dark line, the global balanced, the pale line, the benchmark. You can see a nice pickup beginning since October last year and expected to continue at least for the next 2 years, and of course for the longer term after that, as has been the case for the last 20 years. The global growth portfolio is slightly more aggressive. Year to date, a return of just over 6%. Much more exposure to equities, 62%. Private equity, 18%. Infrastructure, cash, absolute return. Bonds and credit, much less, only 4%, much less than the balanced portfolios. And then these are the geographical allocations. The biggest being in the US, our preferred area, then Europe, UK, emerging markets, Japan. So the portfolios are measured in pounds, but the underlying exposure is in other currencies, reflecting these different geographical regions. And then a very sharp uptick since October. We had a very, very strong market in 2019, 2020, 2021, and then very high inflation, surge in interest rates caused markets to go sideways. We've had that before on previous occasions, but that's always the best time to invest. And yes, we've had a sharp increase, likely and predicted to continue. Our positioning currently, investment companies in which we are uniquely invested. Strategy is unique in South Africa. Investment companies still trade at unusually wide discounts to net asset value, NAV, although they have narrowed steadily from a historic low of 17% registered last year, the widest since the global financial crisis. Investment companies index currently trades at an 11.5% discount to NAV, versus its 7% long-term average. Notable institutional investors and activist hedge fund managers are paying close attention to the value on offer, including Elliott Management, which recently disclosed it had built up a 5% stake in Scottish Mortgage, one of the largest investment companies. The disclosure prompted the Scottish Mortgage Board to announce a £1 billion share buyback programme, which, together with the threat of a hostile takeover and its managed wind down, led to a rapid narrowing in the share's NAV discount. The discount narrowed from 14% to 5% in just over 1 week. Another portfolio holding, Hypnosis Songs Fund, hence the image on the start of the presentation, which has long traded at a wide discount to NAV, last week attracted an all-cash takeover offer for the entire company at a premium to NAV, resulting in an immediate 32% share price increase. Over the weekend, there was a competing bid from Blackstone, causing a further 10% share price jump. Yesterday, the share price, and I don't mean to be blowing our own trumpet, but the share price has jumped 48.5% just since the beginning of the second quarter. Corporate activity, mergers and acquisitions are expected to gain momentum, leading to a narrowing in NAV discounts across the investment company universe. NAV narrowing during the upcoming equity bull market will provide a double whammy for investment portfolios. And although moderate, investment companies generally have some form of gearing, which will amplify investment returns in a rising market. In the first quarter, for instance, the share prices of JP Morgan, American, Allianz Technology, and Pershing Square, all in our clients' portfolios and all focused on US equity markets, each respectively outperformed the 10.18% return of the S&P 500 index over the quarter, with gains of 14.8%, 14.5%, and 13.8% respectively. In Q1, the FTSE closed-end investment index gained by 2.3%. The OAM Global Growth and Balance portfolios gained by 6.1% and 3.6% over the same period. Over the quarter, we concluded 3 trades. The weighting in JP Morgan American was increased to reflect our strong conviction in the US. The share's performance has been strong, beating the S&P 500 index comfortably over 3 years, 5 years, and 10 years. JP Morgan Japanese Investment Trust PLC was added. Japanese companies are increasingly recognizing the opportunities for value creation through higher dividend payouts, share buybacks, more efficient allocation of capital, the sale of non-core assets, and the sale of cross-holdings. And the Japanese market still trades at a 50% discount to the MSCI average on a price-to-book ratio. 24 Income Fund Limited was added to the global balanced and defensive portfolios. The investment company generates its returns principally through income distributions. It targets less liquid, higher yielding UK and European asset-backed securities. Since its listing in 2013, the company has achieved an annualized total return, including dividends, of 7.18%. It pays a current dividend yield of 8%. The next major upleg in financial markets should coincide with the start of interest rate cuts. In the meantime, global equity markets are expected to continue their ascent in line with company earnings growth. Net asset value discounts widen during periods of uncertainty. Here we have it, 2022, a big widening in NAV discounts, and then a continuing widening to the low point in October 2023. They narrow during recovery periods. So here, the recovery, and then a little bit of a dip, a continued recovery. And the recovery, narrowing in NAV discounts, provides a double whammy to investment portfolios. The NAV, underlying NAV is rising, the discount is narrowing, creating a double whammy. NAV discounts have narrowed from the extreme levels in October 2023, but remain wide by historical standards. The long-term chart shows NAV discounts have started to narrow from recent extreme levels as investor sentiment starts to improve. There is much further to go as inflation declines and central banks begin cutting interest rates and a new economic and investment cycle unfolds. So thank you very much. We now have the opportunity for a few questions. So I'm going to hand back to you, Carl, for that.
Thank you very much, Nick. Thank you for that presentation. I think there's a lot to look forward for the rest of the year after a very strong start to the year. Long may that continue. So we've had a couple of questions, as I said, from clients via their wealth managers, and I just want to encourage everyone to reach out to us if you have any questions, and we'll get back to you as soon as we can. So first question is regarding, I suppose it's a technical question on our trading strategy, and it's regarding stop losses. And the question is, why doesn't OAM use stop losses to avoid some of the holdings reaching the lows we've seen in the last year?
Yeah, thank you very much, Carl. Well, stop loss strategies are well suited to high frequency, short-term trading strategies. But we are long-term investors rather than short-term traders. Certainly, there are examples, of course, where a stop-loss strategy would have added value, but there are just as many examples where share prices rally from the precise point of a potential stop-loss sale. We are not afraid to admit mistakes and would not hesitate to sell a share if it perhaps dropped sharply, but the motivation for the sale would be founded on an unforeseen change in fundamentals rather than technical trading weight triggers such as a stop-loss strategy.
Thanks, Nick. So our next question is a question I think many of the wealth managers fielded in the last 6 to 12 months, and it's regarding the ND Global Monthly Income Fund. The price is down nearly 27% year to date. And the question is, what's happening with the stock and why are we still holding on to it?
We have been receiving this question a lot. Shareholders approved a managed wind down of the company on the 27th of January 2023. The company has been realizing assets in an orderly manner to maximize proceeds, which takes some time given the exposure to private and illiquid assets, with the board indicating this process may take up to 24 months. But they made very good progress. By November last year, the company had completed its 5th compulsory redemption with assets traded at or above NAV. It looks from clients' valuation statements that we send out every quarter as though the investment has lost a lot of value, but one should account for the 5 successive capital distributions. The managed wind down has in fact added to investment returns as the share was trading at a discount to NAV, but the capital distributions were made at NAV. So far, the company has distributed over 90% of its assets. We hold on to the share despite it having little residual value until the managed wind down has been completed and the share is delisted. This really does provide the best outcome for clients. To trade it would not be a good idea. The share is illiquid with a market capitalization of less than £10 million and trades at a 25% discount to NAV.
Nick, the final question is about the Chinese equity market. And Nick, you've touched earlier on the Chinese economy and exports growing at 20%, but the equity market has really disappointed in the last year. The CSI 300 is down nearly 12%, and that's largely been ascribed to the ailing property market. So the question is this still a good investment case for China?
Yes, China is still a good investment case. The property market has dropped precipitously, but the rate at which it will continue dropping will decelerate. China's stock market is valued at a substantial discount to other emerging markets and also compared with its long-term average. Yet the economy is on course for 5% GDP growth this year based on the government's own official target. The greatest hindrance to investor sentiment must be government's ideological pivot from market-oriented growth to its common prosperity goals. However, government does care very much about economic growth and healthy financial markets. Government is aware of the damage it has done to the private sector, business confidence, and consumer confidence. But we mustn't forget that in the past, Beijing has engineered massive directional changes in its ideologies in the past and may very well do so again. We have exposure to China and also to Southeast Asia in clients' portfolios through various investment companies, including Fidelity China Special Situations, Schroeder Asia Pacific, Schroeder Oriental Income, and Vina Capital Vietnam. So we're very comfortable holding on to those, and definitely we could rebalance and increase that exposure if and when government ups the ante with its policy response.
Well, thanks, Nick, for answering those questions. I think that brings us to the end of the webinar. I'd like just to thank everyone for joining this session. It was certainly a pleasure to prepare and put this webinar together. We'll also, after the session in the next couple of days, we'll post a copy of the webinar to our YouTube page, as well as make the presentation available to our wealth managers, who can then distribute it to clients and prospective clients. So Nick, thank you for the presentation and the rest of the team. And I hope everybody has a fantastic day and the rest of the quarter, and we'll see you soon.
Yeah, thanks guys. Thanks, Carol. Cheerio.